All right, don't hide that stain, but I probably could use some concealer this morning. All right, let's talk about it. This is The Real Story with Adam and Sherry. I'm Adam Hamalian,
And I'm Sherry Hutchens.
and this is where two broker associates talk about all things real estate. Hey, Sherry.
Hey, Adam.
I, I,
Are you telling me you're using concealer?
I might need some. I cut myself shaving this morning, and I didn't realize how bad it was going to look on the Zoom call. And I'm just going to have to live with it. And
You know what?
apparently, you don't have concealer in your desk here that I could borrow.
I've never used concealer. I
Uh,
don't even use foundation, so
well,
I can't
good.
help you. But if you hadn't pointed it out, nobody would have noticed. And now the whole time, everybody's going to stare at it.
I'm going to put my mic in front of it so you can't see it. All right.
Okay. All
Um,
right.
all right, moving along. The market really hasn't changed that much in this last week.
No.
No, and if you are listening to this third week of July, check out our most recent newsletter where we go into more detail about what happened during the second quarter. It's really kind of fascinating. Kind of the headline there is 48% of homes in the second quarter sold below their initial list price in our primary market area in Contra Costa County. So, more details, you want to look that up. Uh,
Right. That's a big number.
it is a big number, but I think we've been feeling it. It wasn't a surprise to have that quantified. Hey, you came up on the anniversary of your broker's license, didn't you?
I did about 10 years ago this week. I was getting ready to take my exam.
Oh yeah, and how did you get reminded that you were right around your anniversary?
So, for those of you who know my mom or know of my mom, she had some kooky things to say at times. And, there's nothing better than your mom coming on Facebook and commenting on your posts.
Oh,
So,
wait, your mom was trolling you on Facebook? Yeah,
remember when she tried to get me to marry my uncle?
yeah. Well,
That's a different podcast.
are you too good to work on the farm? All right, so your broker's license, back on track.
Yes, so I posted that I'm getting ready to go to boot camp to for, the last bit of studying before I took my exam. The broker exam in California is 6 hours, and even though I had lots of experience, I guess 15 years at that point, I was still kind of nervous. I didn't want to flunk, because what would that do to my reputation? So I posted that on Facebook. Um, and my mom said, I'm so proud of you. You've come a long way, Sherry, from the girl who left home and didn't know how to cook a hamburger.
Gee, thanks, Mom.
Exactly. It is true that I couldn't cook when I left the house, but that's another podcast.
Yeah.
And my sister chimed in and said, she's taking a broker's exam, Shirley. She's not going to the cordon bleu.
Wait. Your sister called your mom by her name,
Yes.
Shirley? Uh,
Yes, she often called her by her name.
That's hilarious. So your mom trolled you and your sister trolled your mom.
Welcome to my family.
I have no words. I just think that that would be hilarious to be around so many people like that.
Oh, that's one word for it.
Yeah,
I
yeah.
passed my broker's exam, by the way, and I do know how to cook now. So all is
Hey,
good.
when I took my broker's exam, took it at a testing center in Oakland, and when you pass, they don't tell you your score. They just say, "Hey, you passed."
Yeah.
And thankfully, I passed the first time, and I went and I was leaving the building, and there was a woman in the elevator sobbing, and I
Oh,
like it
no.
was like visibly shaking, and I was like, well, you can't just ignore this. It wasn't just like a silent. I had to try and say something, hopefully that was comforting, and I don't
Yeah.
remember the exact words I said, something like, you can do it again or hang in there, and she goes, oh no, these are tears of joy. I passed. This was my fifth time taking the test.
Oh, no.
Could you just imagine just kind of the desperation and the emotional release of finally
Oh, my
passing?
gosh. Poor thing. 5 times.
Yeah, but I bet she knew how to cook a hamburger.
Uh-huh.
Uh-huh.
Really.
All right. Let's move on to our guest for this week. We're excited to have Arlo Zoerner with us from CrossCountry Mortgage. This is his third time. Not only is he our only repeat guest, he's coming for a third time.
A
Really
three-peat.
a three-peat. Hey, Arlo.
Hey,
Good morning,
Arlo.
guys.
How you doing?
Doing wonderful. Thank you so much for having me, and I'm completely honored. I am a little surprised. I'm I'm three-peating. I didn't know that. That's great.
Yeah. Well, I just think that, mortgage rates are always things that need to be kept relevant. And, things are changing, obviously, with the change of administration and other factors. And it's just good to kind of help people pay attention to what's going on, both for purchase and refinance, and also kind of
Yeah.
looking into the future, of what might happen. So we're really glad that you're able to be here. Everything, business-wise, keeping you busy?
Yeah, business wise, business is going wonderful. It's been, we're 3 years into a quote unquote, whether it's housing recession or mortgage recession, but we're 3 years into this climate, so nothing new at this point. Couple daughters, 5 and 9, so summertime, busy there, busy on the professional front. As a friend of mine recently said, he will sleep when he dies. So
Okay.
I'm kind of living that world right now.
Yeah, especially with two young kids, I can imagine.
Yeah,
It's
that's
a
fun.
lot.
It's fun.
Well, why don't we maybe you can give us some updates on interest rates, kind of what kind of movement seem like they've been kind of steady, but maybe just kind of tell us what's going on and where you think they might be going.
Yeah, absolutely. So interest rates have made some really nice progress during the last 8 weeks. Um, and they sit at 8 month lows. That's made a few headlines
Oh,
recently.
wow. Did not know that.
Yeah, yeah. So the initial impact of the tariffs announcements seem to have worn off. That was obviously a very wild couple of weeks. But here we are a few months removed, and mortgage rates are down about 0.5% since that time. It's ironic because everybody felt like these tariffs are going to create inflation because the cost of goods are going to go up. Inflation is going to drive rates up. Um, but here we are, a little bit farther down the road, and mortgage rates sit spread throughout the entire sixes. You have
Ooh.
some conventional rates right in the middle, around 6.5, plus or minus maybe a little bit, depending on profile. Um, FHA and VA rates, because of the insurances and guarantees that they carry, those ones are a little more attractive. So actually, the very top of the fives or bottom of the sixes. And
Wow.
then Yep. And then
That's
jumbo,
amazing.
yeah, jumbo is in the mid sixes. And I've had a couple of some of my better rate locks. I locked a consumer at 6 and an eighth on a conventional loan, 30-year fixed, and another first-time home buyer at 6.375. So if all the pieces of the puzzle are just right, these are some numbers that are a lot better than starting between 7 and 8, where we spent a lot of the last couple of years.
Mm.
Yeah, that is really good news.
Yeah. 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 So in
Um,
terms of, go for it.
was there a inflation rate came out today? Was there an announcement about that? I felt like there was something.
I haven't seen the actual number that came out. I don't think it was a shock up or down, but I did see on CNN, somebody was just commenting how we're a couple months into this tariff time, and so far it's not wreaking havoc on the cost of goods, and it's not wreaking havoc on the actual inflation rates. So we're still in a wait and see there. I mean, the current administration and like whether it be the tweets, and some of the announcements that don't stick, but they just make some headlines and create some chaos short term.
Mhm.
We're still very fresh overall in the journey, but as of right now, the tariff impacts have actually been much less, and we're just not seeing prices move as much as the initial fears were. But the media is driving fear, so hard to believe. What was so fearful and going to end the world a few months later is not quite as significant so far.
Yeah. Seems like you were saying about the initial announcements and kind of things have evened out. Um, it seems like even the stock market took a huge hit on the first day, and it's well recovered that and even grown since then.
It's crazy. The stock market did reach a fresh all-time high, I think a week or two back. And so, side note, kind of off topic for mortgage rates, but I met with a financial planner right around the very beginning of July, and the S&P 500 was up 3% year to date at that time. So it recovered from that craziness that we went through. Halfway through the year, it's up 3%. That means it's pacing for a 6% gain. And given everything we've gone through, and again, all the fears and all the potential things that the world was going to end type of talk,
Yeah.
we're chugging along, and the markets have booked some gains so far.
Yeah.
So see if that continues.
All
Mm.
right. Well, there was some discussion about the inflation number coming out and how the Fed rate might be affected by that. I know everybody's complaining about Powell and everybody wants him to act faster and do something, but do you have any thoughts on, I mean, I know that's not directly related to mortgage rates, but it's passively affects that. Do you have thoughts about
Yeah.
Powell's action or inaction?
Definitely a loaded question. I think the challenge is, as people who watch financial news and even just like looking at the real estate market, so much pushes and pulls. It's not just like one, there's not just one angle on these things. So much pushes and pulls. You know, to ground that question, let's keep in mind that the Fed's job is to control, they have two main objectives, controlling inflation and managing the labor market. And they've actually done a pretty good job with both of those things during the last couple of years. For the time being, it feels like they've managed to have what's called a soft landing and keep us out of recession. And on paper, that is. Some people would
Yeah,
argue that we've been going through a recession, but
right.
the actual data coming in is not saying that. Inflation has been in the mid 2% range for nearly a year now, and their goal is 2% even. I think
Right.
it's run like 2.3 or 2.2 or 2.3 on the low side and 2.5, 2.6 on the high side. So that in combination with labor markets, which have been very good still for the last few years, although they're finally showing some signs of slowing and weakness. In terms of the Fed's mandate of managing inflation and managing the labor markets, they've actually done a pretty good job.
Yeah, it seems that way. I mean, I've been reading about big tech layoffs, but I'm not sure how many of those are actually here in the Bay Area. Have you seen any of that amongst your clients about the joke I hear about tech jobs is that if you've had the same job for more than 18 months, you're ready for the next one. So it's kind of like the layoffs don't really scare me. Like if you don't have 10 different companies on your resume in a 20-year career, are you even in tech?
I think the issue there, and that's totally accurate. I think the issue there is the rehiring, like moving by choice or when we're in a stronger tech environment, people are upgrading and they're leaving by choice to get something better. Um, but some of these layoffs right now, I think some of the concerns are is that it's going to be harder to replace the job. And that is something that has been prevalent for the last year-ish is like laborers and people who are like um, working in retail. Retail had struggled to get enough people to work. So those wages have crept up quite a bit. But some of those higher end jobs, from what I read and what I follow, 150, 200 to like 150 and up salaries, it's harder to find and replace those jobs.
Interesting. Yeah.
Yeah.
Hmm.
Um, any of your thoughts about and I took us away from interest rates, but kind of predictability about Powell taking action, how that might affect home buyers and what they ought to think about, like wait, do it now and refinance. What any thoughts about it?
Yeah. I mean, a couple other things that we didn't touch on. Hal's term is up in the spring of 2026, and it is basically concrete at this point. He is not getting reelected for another term. So we're going to have a new Fed chairman come next spring. Um, it's also looks like extremely likely we're going to have two rate cuts left this year, not one here in the next few weeks. But September's projection right now is for a 90% likelihood that we'll see a rate cut.
Hmm.
And it looks like they're probably followed up in December, although new data may sway that differently. So I don't think a lot changes through like the market's already pricing this in. We don't need to wait until September and then they cut rates. Like nobody's going to be surprised when that happens when it's, let's say, a
Yep.
90% likelihood or 95% likelihood. So markets today are already pricing that in. But what will move markets then is the words that he's going to use about the future and trajectory. But a part that's just completely unique to our times is that his term is up in the spring. We're definitely going to have a new Fed chairman. And so the big question right now, and what I'm hearing within my industry, is we're going to deal with things as they are for the next 6 to 8 months or 7 to 9 months. But the big question mark is what's the new regime going to do or the new Fed chairman going to do in the spring? How quickly will they act and what will those impacts be? I mean, expectations that they're going to bring rates down. But again, it's like until it happens and until we know. But those are the projections. And so, to answer your last piece of what you said, I think actually right now is a amazing opportunity because if you look at inventory levels are much higher than they've been in many years. So there's more choices for buyers. Then we're met with 8-month lows on rates. And I'm talking about some rates that are in the bottom of the sixes as opposed to 7 to 8. We also know that if I was here saying mortgage rates are 5.25 or 4.75 or 5.0, there would be so many more buyers in the market and that would
Yeah.
drive prices up. I think
Mhm.
there's a great opportunity during the next 6 months to take advantage of a softer. You cited in the beginning of this call, 48% of listings and properties sold were below the list price. Let's like articulate this and put it together. Nearly half of the homes that have sold below list. Inventory levels are some of the highest levels we've seen in many years. And oh, by the way, mortgage rates have actually reached some levels where it's not the 4.5 to 5 maybe people want to see, but it's a great opportunity to lock in sales price and loan amount and then do a refinance in a year, 6, 9 months on the short side and 12, 24 months on the long side, and maybe make that next cut to your rate.
Yeah. All right. Good advice. Yeah, hopefully we can get a little more buyers off the sideline and get them into some houses. I mean, you got to live someplace. Why not own your own place? All right, I'm overselling here. I apologize. But yeah, I mean, I think that I mean, just having the interest rates be as palatable as they are compared to the last 2 years, 2.5 years, yeah. I think the challenge is that the quality of the product out there isn't as enticing as it previously was because when
Yeah,
things were overselling, sellers were doing a really good job polishing their homes up, and now it's like
yeah,
I don't know that I'm going to get my money out of it, so I'm not putting money in. Sherry, do you have thoughts
interesting.
about that?
Well, and also during the craziness of 2020 and 2021, it almost didn't matter what the house looked like. Everybody was just so desperate to buy a house, they would take almost anything if the price was right, and the price was usually high. So, um, the part of this whole equation that hasn't happened yet, interest rates are coming down a bit, inventory has gone up. We should see more buyers getting into the market. And the reason we're not is because sellers have not had a reality check yet that they need to price their homes more aggressively. And we hear agents around our office saying, I'm trying to get a price reduction from my client and they won't budge. We've had the experience of, having clients who think their house is worth more than what comps say they're worth. So,
Are you
as
talking
soon
about me behind my back in front of my face?
of course, not. I would never do
Sherry
that. But
helped me sell my familyhood home, and I was a horrible client.
no, 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 no. Well, your timing was great. So luckily we didn't have to worry about that.
Yeah,
But sellers need to realize that if they want to sell their homes, either they've got to fix them up and make them look perfect, or they've got to get their pricing strategy in line with what's going on with the market.
yeah.
And
It's
that will clear the backlog that we're sitting on.
Yeah. We had a transaction just in the last month or so where price reduction, we actually had to do two price reductions, and it was a hit to my ego. I don't know how, Sherry, how you felt about it. Because I believed in our original price, but it was like we just missed the window of opportunity. And I had a hard time admitting that we needed to go farther down.
Hmm.
It
Um,
didn't bother me because I went through the recession.
yeah,
So it
yeah.
was 5 years of price reductions.
Um, so it was interesting in a market. I wouldn't say we're really in a down market. It's just changing because there's still things that are going multiple bids over, but appraisal is starting to become an issue. Arlo, have you seen any issues coming up with appraisal?
I'm bracing for it, but fortunately not so far. I'm not seeing an abnormal amount of issues with appraisals. And without trying to pinpoint a specific number, very few are coming in short. If I think about the last 10 to 20 transactions that I've done, one stands out. Not sure it made sense. It came in pretty short. And then outside of maybe one out of 15 to 20 transactions in the last quarter, as an example, no, the appraisers seem to still be supporting purchase price.
Y-
Um,
Yeah, we've seen that, but we're starting to see like more and I'm not sure whether it's coming from the underwriter, but more requests for some details about the property. Have you started to get more requests from underwriters via the appraiser?
yeah, underwriters. go back, like it's product specific is what I typically see. So as an example, on a conventional loan, the the underwriter reviews the appraisal, and when they ask for revisions, they're generally just clerical.
Mm,
But there's not like a mandatory second level review. On jumbo loans, there is the appraisal comes in and there is an independent review. And quite commonly, I'm seeing that appraisal not come to me. It kind of gets held, and I get notification that says revisions are being requested. But again, they're clerical because usually 24 to 48 hours passes, then the report's released, but it has not had an impact on value.
interesting.
So, yeah, so most of what I'm seeing, some revisions can be common, whether it's underwriting or from an actual appraisal review, like our appraisal department, and that's what they do, quality control.
Mhm.
But they're not having an impact on value. So I view that maybe as like a nuance because you want a report to come in and it comes in and then you don't get it because revisions have been
Yeah.
requested, but then it's all kind of blows over and it's been fine.
Mhm.
That's been my experience for the most part this year.
I think what makes me nervous about this, because we've had a couple, I don't think we've had any cut sales, that meaning the appraisal came in below the list, the sales contract price.
No, not for a while.
Yeah, but we are getting requests for information.
Yeah.
And what makes me nervous about that is, so lenders, will be, Arlo, you'll have to clean this up how I say it. They may they are the originator, but then they'll repackage it and sell it on a secondary market, which is what got us in a huge recession, where there was all these loans that had deficiencies being packaged together, and then they started going south. And there's part of me that wonders whether lenders are trying to be more diligent in making sure that they're, by crossing their T's and dotting their I's and taking care of all those details, that they don't get kicked back. Because what was happening, with mortgage insurance, the mortgage insurance company would issue the mortgage insurance on a product, and then when it defaulted, they go back and look at it and say, "Oh, you didn't do it right," and kick it back to the originator who had to eat it. Is that right? Did I got that?
That is was definitely happening. And corporate sometimes is so guarded, or they're making us do things that we feel on the front end as a loan agent, or even, and then you as a real estate agent get dragged through it, or there's a delay. Like we want something to be done on a certain date. It comes back, revisions are requested. We all have to pause and wait. Yeah, the requirements of these investors on the back end, and I'm not really far into that rabbit hole, but the bits and pieces I hear, I mean, some partners that we sell loans to or purchase the loans or insure the loans, some partners are much better than others. But what they kind of have to deal with on the back end with that and what the financial recourse is when something's not right, that's why they're so guarded. I mean, they are not doing it because they want to be policing or want to be that detailed and specific about some of these attributes. They're doing it though because depending on the end investor on the loan and what that relationship is like or what those tolerances are like, it can be a big financial loss and challenge when you have a loan slated to go to one place. And then if they pick some, and obviously like consumer, like loan agents and consumers are always choosing the best price options. So there's can be some really big drop off when something doesn't slot or fit in the right place and they kick you out and then you have to go to the next best. Well, the rate and the money stuff was all set at the time of the loan closing. So corporate can end up taking a pretty big loss. So that's a part of the industry. They're just guarded, not because they want to be, but because of what those relationships are like with the investors.
Yeah.
Hmm.
All right.
Yeah.
Interesting.
Yeah.
So I think that between the three of us, I don't think that we are anxious that the market is going to crash on us, but I think we're cautious and have enough experience that we're noticing some changes and just kind of want to be prepped for it. And I'm just wondering, again, like you pointed out earlier, when the tariffs were first announced, there was, the chicken littles and the sky is falling were all over the place, and it hasn't actually happened yet. It doesn't mean that we're out of trouble, but I'm just kind of curious. So for a consumer who's they're bracing to go maybe the next 12 or 18 months where it might be a challenging market for them personally. What are things that they can do to help kind of keep their either get or keep their household economics in order, particularly thinking about the lens of credit score? You have any advice? Because I know you have to help people fix that sometimes.
Yeah. Yeah, we will look at scores, and if everything's perfect, leave it be. And then if sometimes moving scores up a little bit would be beneficial, we'll make some recommendations and run some score simulators and help guide them. I mean, the number one thing is just to make sure that you're never having a 30-day late. Um, a minimum payment is always fine, and carrying a high balance is not permanent damage, because when you're carrying a high balance, you can work on a plan to reduce it over 3 to 6 months. And so that's so fluid. That's not going to be a permanent mark, unlike maybe a 30-day late or a collection, which is a permanent mark.
Mm.
So make
Mhm.
sure you're never late. Story I got the best safeguard when I run into some clients, and sometimes it's like the people have plenty of money, have great credit, but they have a couple 30-day lates in the last 12 months. So the best safeguard that I always try to recommend is consider setting up that minimum payments will be drafted automatically from checking. Because I always personally had this fear of like, all right, my credit scores are perfect. I have enough money in the bank. I have a credit card bill that's a couple $1,000s and it's a $30 minimum payment. But what if the bill gets lost? Like, what if I'm kind of old school? They actually still send them to me in paper. I get
Mm.
them and I pay them. But what if there's a mail problem and I just don't really, I have 3 or 4 credit cards, and life is busy and life is crazy, and you don't realize that one of them didn't get to you, and so you just pay the ones you have and you move on and you miss it. Well, that's going to create a 30-day late. So I think one of the safeguards I really love is consider on all of your credit cards just setting up so that your minimum payment will draft out of your checking on its due date. That way, if you fall apart, and I mean, mine come in paper, so for me that system's easier, but a lot of people are doing paperless billing. I mean,
Mhm.
missing an email, you miss, like, you open one email and don't mark it unread and forget to come back to it,
Yeah.
and that creates a 30, that, I mean, that drops your scores 60 to 80 points, or nearly 100 points on that initial right after it happens. So I love doing that. One time I got my credit card bill, paid it, and it was like $8,000, is a little bit abnormally high. So then the next month I get my credit card bill and my balance is 16,000, and I'm thinking, what happened here? This is impossible. I did not charge this much. What happened was when I went into my bill pay to pay it the first time, I just misclicked and went one line below. And so I paid my garbage company $8,000 one
Oh
month
no.
Oh,
instead of my credit card bill in full one month. And so then the
oh,
next month I get it. But thank God. I mean, that's just an example of like, how easy is it? It can happen in different ways. So that's a great example of like, but I had already put this process in place where my minimum payment was going to just be drafted for my checking. So they probably drafted $80 or something really small. You're checking. I'd rather have an overdraft or an insufficient funds, but it gets paid and I deal with my bank on it,
Yeah.
than deal with a 30-day late. So that's a really great thing that it just takes, it's almost fail proof. I mean, that's a great way to make sure that you're not going to have a 30-day late. Um,
So how far in advance are you paid on your garbage now? Like till the year 2050?
yeah, they sent me a check, I called like, yeah, okay. They sent me the check back. I'm like, all right, this is so, they sent it back. But thank
thank
God,
goodness.
because that would have been an example of just operator error, right? A
Yeah.
missed click, a missed piece of
Yeah.
mail, an email that you thought wasn't read. Outside of that, if you have like a 740 and higher, or 760 to 800 score, don't change anything. Just keep doing what you're doing. Make sure you continue to use your credit a little bit, because you need to be using the credit so that the small promise is kept. Each time you charge each month, pay on time, it's like a small promise kept. So, but if you've got those scores, that's great. Then you don't need to change too much. So don't be late. Couple takeaways. Don't ever be late. Try not to close any revolving credit cards that you have. Um, Sometimes I'll meet consumers and they have 100 grand or like a lot of money in the bank. Like, well, why would I need to use credit? I don't need credit because I have money. I just pay for everything in cash. If you do that, eventually your scores will go away, because there's no data to come over and report. Like, actually, after a couple of years of doing that, especially if you didn't have a mortgage and don't have car loans, if no data comes over, your scores will eventually disappear. So don't close anything out. The depth of those cards are super important. And if you quote unquote don't need to use them, because you have plenty of money, you still need to just a couple times per year, maybe once per quarter, or at least a
Yep.
couple times per year, charge a few $100s, let the bill come, pay the bill in full. You will not pay any interest, but you will keep that data stream alive that you need to so you have your scores. Managing the threshold, so like debt utilization. When your balance is at 80, 90, 100% of the credit limit, that's going to hurt the score and deteriorate the score quite a bit. And then the other end of that spectrum would be keeping your balances below 10 and 15%. That's an optimal range where you're not going to be dinged or impacted from debt utilization being too high. So those would be some examples of just simple things you can do. I always try to look at like, what are things I can do that aren't going to cost me money? I don't want to send somebody to Best Buy and say, you have to go there every month and spend money. Like if they don't need to, then that's, I don't want them to have to add costs into their budget of living to be able to play that game. But those would be a couple simple recommendations where simple practices will help promote the highest scores over the long term.
Do home equity lines count more like a mortgage or more like revolving debt? So like
More
when,
like a mortgage. Yeah.
okay.
Yeah.
Mm.
They're not, which is very favorable, right? Because you set up a home equity line of credit for 100,000. You do your home improvement or you purchase another property and you do the investment or whatever it is that you were going to do with those funds. Having those at the higher limits is not going to be a score deterioration. It's specific to more of like revolving credit cards is really the big driver.
Yeah.
Yeah.
And then like where would installment loans, like a car loan slot in there?
For the most part, they can kind of just hurt you if you're late. They don't do quite as much because for some reason, and I don't agree with it and it doesn't make sense, but you get a 5-year car loan and you pay $432 every single month. It's just a fixed loan for 5 years. If you're late, it's definitely a big problem and a big score setback. But paying on time, it's not nearly as impactful as the credit card where you charge up, pay off, charge up, pay off. So,
Interesting.
and then actually they close out because you get a 3-year car loan. It's helping you maybe just a little bit as you work farther into that period, but then the account closes, and once it closes, you're no longer getting, no pun intended, credit for
Yeah.
the depth of that account. So the
Mm.
credit cards are the number one driver, and that's why if you have a credit card that's been open for 2, 4, 6, 8, 10 years, I mean any amount of time, once it's 2 to 4 years old, you have to just use it a few times per year and make sure it stays open because the
Mm.
depth of those accounts, so much of your score is based on the depth, and car loans will come and go much more quickly, but you can keep a credit card open for a longer period of time. It's really important.
All right. All right.
Interesting.
Yeah.
Sherry, any questions you got for Arlo on this topic?
No, I don't think so. Very thorough. It's always
Yeah.
interesting to know how that FICO score is arrived at.
Yeah. Yeah. And I mean, based on what you just said, one tool is when we run someone's credit, we get their scores. So if we come across somebody who has a 640 to a 670 score as an example, we can actually go in and do a score simulator
Mm.
where we can go into their report, edit the balances on different accounts, and then this computer will simulate and tell us what the score will go to. So
Oh, interesting.
maybe, yeah, so maybe like a bunch of programs or investors open up with a 700 score and you have a 685. So you're 15 points away. We can actually go into the report and change the balance on this card and change the balance on this card and even look forward after 2 or 3 months of reporting, and it'll tell us what the impact would be. And we
Mhm.
can also go in there and say, what do I need to do to hit 700 and what do I need to do to hit 740? And it'll just tell us, it'll optimize and tell us for the least amount of money, here's where you would need to pay all of the balances to. So it's not needed when someone's scores are perfect, it's not needed. But sometimes I pre-approve a borrower in January and they don't find a home until the summer. So there may be a window of time where we can give them a roadmap, have them work on,
Mhm.
a little bit of some goal setting on what they can do with their scores and find some improvement along the way.
Oh, what a great tool.
Yeah. Yeah.
How long,
Outstanding.
how long does it take to show up on a FICO? If you use the simulator, they pay off a couple cards.
Really good question. Typically about the range is 2 to 4 weeks, but like roughly 3 weeks is a good barometer. So if last night you went in and made a payment on a credit card last night, we
Mhm.
can't wake up this morning, recheck your credit, and then it's not, the balance won't be there. So
Right.
you would have to have paid it down last night and you can't get back into the card for the next few weeks, right? Because you have to wait till that reporting comes over. It varies a little depending on institution and what days of the month they report to the credit bureaus. But a good rule of thumb is about 3 weeks.
Okay.
And for the last few years, we've been able to do what's called a soft inquiry, which doesn't even count as a real inquiry.
Hmm.
So, excuse me, during pre-approval, we'll just do a soft inquiry. It doesn't count as a real one. We can give you some score simulators and projections. You take a month or two as a consumer to work those balances down, and then you tell me, hey, I just you just let us know we just got the balances down to where they need to be. We'll set something in our calendar, and in 2 weeks we'll check it, see if it's there, because we're still just doing a soft inquiry. So those checks they're actually free and they're not counting as a ding or
Hmm.
an inquiry. So we can check it at 2 weeks, check it at three, and then wait till it's in your balances. And so some good options to manipulate and help the consumers improve their scores.
This is a little off topic, but maybe you can um, enlighten me. I was under the impression that there were no risky loans out there that would cause a problem like what happened in 2008 again. But I heard somebody the other day talking about a no doc 1099 loan. That sounds like a risky loan to me.
Yeah. The non-QM world is a little more expansive than one would think. But there are still some checks and balances. So like the ultimate recipe for disaster during the Great Recession, 7, 8, 9, 7 to 10, 27, 2010, was like you're stating your income, so there's no verification, and you're also maybe putting nothing down. So you're
Right.
financing the whole entire home, and you're working in retail saying you make $12,000 per month.
Hmm.
Um, so like that's not really there. But there are stated income loans right now, but they're making you come in 20 to 30% down. So there's some skin in the game. The checks and
But that's the
balances,
difference.
yeah, I mean there's way more checks and balances. The loans make more sense. Um, they're being used on a very small scale. And if you
Hmm.
look at delinquency rates, our delinquency rates, the issue that you have here too is and things evolve, so markets change. But what one of the big kickers is that homeowners and just the American real estate market as a whole has more equity in it right now than it's ever had. And so when you have a lot of equity, you're not going to default.
Right.
And that's, I think, one of the big differences is like these loans are more protected by the equity. And if you have a $900,000 house with a $580,000 loan, at the end of the day, you're not going to default on that loan. You would sell that home and at least clear
Right.
the equity out.
Right.
So
That makes sense.
there's some really creative products out there, but they're being used. The suitability is way better than what it was during that
Hmm.
time that led us
Okay.
into that problem.
All right. Good to know.
Yeah.
Good to know. I remember the zero down loans, and when somebody couldn't make zero down with an escalating payment depending on what month it was, and it made it really easy for people to just pack up and leave.
Yeah. When there's
The
no skin in the game, and there's just like it was layered risk. There
Yeah,
wasn't just like one attribute. There was just too many layers of risk
yeah,
during that time. And for the most part, again, I think the delinquency ratios could just speak for themselves. We are absolutely at record low on you'll hear like foreclosures ticked up. Well, they went from like point 0.2 to point 0.4. I mean, like
yeah.
they're going to be up and down movement, but right now delinquency ratios are very, very good. And that's tied with like how much equity consumers have. They're not going to let something go under where you have 2 to 600 grand of equity as an example.
Hmm.
And that may shift a little bit, but for the time being, that's where we are.
Well, let's not go back there. That was no fun.
I don't think we're headed back there.
Yeah.
Yeah.
Well, great. This has really been fascinating. I think we went farther on that last topic than I thought we were going to. It was really interesting stuff. Thank you so much, Arlo, for joining us.
Yeah.
I guess I should give you any last chance to make any other comments about the market or anything that you want to add that we didn't get to cover.
No, I think people just needed, as I read and intake different content and some of it from other loan officers, some of it from financial news and markets. Another loan officer recently summarized, when is the right time to buy? Because buyers are looking at inventory, rates, should I wait? He just summarized it so well. Like when all the pieces of the puzzle fit together, that's the right time to buy.
Yeah.
When your finances allow you to do it and you can be properly pre-approved or you have cash. find the right home and the monthly payments are going to work, that's the right time to buy. A mixture of like how he phrased it and said it, and also from the financial planning world, um, timing the market is nearly impossible or very difficult, but
Yeah.
try to focus on time in the market. And
Yeah.
so, just the sooner you can get that stake in the ground and focusing on the how long you're going to own the real estate, time in the market is going to be way easier. And I really don't think you need to worry about, well, am I buying at the peak? Time heals all wounds is another
Yeah.
phrase, another statement.
Yeah.
Uh, don't I think there was one 10-year period in the last 120 years where if you bought at this one specific time, you actually were not making a profit 10 years later. But there's really no windows where if you can wait things out a little bit when we hit a down market, time heals all wounds in real estate really nicely. So
Yeah.
when the pieces of the puzzle go together, it's always a great time for home ownership.
All
Yep.
right.
Yeah.
That sounds great. If you're listening, you got questions about mortgages, whether you are going to be a home buyer or a refinance, we will have all of Arlo's information with CrossCountry Mortgage in the show notes, and he'd be happy to answer those questions for you. With that, I think we're going to sign off. If this was helpful for you, be sure to recommend it to your friends and family and subscribe. We'd love to stay connected with you. Dorothy was right. There's no place like home.